Risk is where two variables meet: the probability of something happening and the damage that it can create. But if you have $1 million and the probability you lose it is 100%, that is the highest risk you can have.
For crypto, I look at a chart and I look at how the trend is going. You want to buy altcoins that are in uptrends, because if you're buying an altcoin in a downtrend, you never know when it's gonna stop dropping. So you have to put the odds in your favor.
We do talk a lot about buying, right? But portfolio management, portfolio allocation, risk management is not only about buying, right? It's also about selling, knowing when to exit.
Welcome to the Market Buzz Deep Dive. Ever wonder how a solid long-term portfolio is built? In this episode, we'll reveal how top investors allocate risk, capital, and plan for long-term growth, ensuring investment can weather any storm. This takes me to our next part, our next topic, our next segment, which is risk, understanding risk and how you analyze risk in every single position that you're taking, right? For example, my father says this, one of his big sayings: risk is where two variables meet: the probability of something happening and the damage that it can create, okay? So if we have high probability of something happening, but you're gonna lose $1, who cares, you know? But if we have, in that case, the probability is, the risk is low because the damage cannot be bad. But if you have $1 million and the probability you lose it is 100%, that is the highest risk you can have. So thinking like this is always what has allowed me to kind of take into consideration is like, the way that I diversify my portfolio and I break it down is like, okay, I have a long-term allocation of the companies that I truly believe in 5 to 10 years, they will continue to be here. Worst case scenario, they grow very slowly. That is big. I leave that on the side. That is probably around 70% of my portfolio. Then I have companies that I really like, and in the moment, they are hot. I feel that they're going to change the world. Nvidia, I keep coming back to this beautiful, like the best employee I've ever had is Jensen. Because when you buy a stock, you're buying a company and you're the owner. The CEO works for you, But then you put money heavy into those companies, into your first choice. You know what I mean? The companies that you truly believe in. That is like around maybe 10, 20%. And then I leave always 10% of cash reserves where I'm like, I'm waiting for the opportunity for Intel to drop to 17. And then Intel drops. You buy the stock, you snipe because you know that the stock has just been punished because of bad news, but not because of the fundamentals. And that's why the research helps too. So I want to understand, how do you look at risk? What is the thing that you pay attention to whenever you're looking to place a position? It's a tricky one.
Tricky one.
It is.
It's a tricky one.
Everything is different because you cannot quantify. It's not like, In this company, I have high conviction. But why do you have high conviction? The same conviction you have on Nvidia might not be the same conviction that you have on Amazon.
Absolutely.
So it's very hard to quantify. But creating those parameters, and the more you invest, the easier it becomes. But for example, in my short-term portfolio, in that 20 to 10% of my portfolio that I was talking about, my short-term trading, I tend to have a breakdown. So for me, that breakdown is usually if I have an extreme high conviction on a stock, I will put 25% of my portfolio on that one stock. I will go all in on that move. But if I have very low conviction, like buying some, like Mara, like a slow conviction trade, I will go maybe 1% to 2%. Because the upside might be higher, but the risk is also higher. So I tend to go smaller. So cryptocurrencies, I tend to go small. I think Mara is the only Bitcoin position that I have on my eToro portfolio, and that's very small. Because I'm like, I think Bitcoin is going to do great, but I have no idea. So I'm gonna bet on it, and if it worst case scenario, the gains from Nvidia will pay for my mistake. So something to consider.
Yeah. So the way maybe I can take it. So the way that I try to assess risk. So I don't use your father's equation, which is in my opinion, is a really good one. But I look at it a little bit differently. When there's a company that I find interesting, maybe I heard about it on TV or I read about it. I try to see the financials of the company from like as far back in history you can get to, right? And if you can see that consistently the company is growing, and also then you look at the forecast and consistently the company is expected to grow, the risk is already lower, but it's not sufficient. You need to look at that, but you also need to look at the valuation. So if the stock is cheap, or at least in line with historical valuation, in my opinion, the risk is moderate. There's always a risk, there could always be something happening, like something unexpected. But this is true for any investment. There's always something unexpected that can happen. So I have to carve out this unexpected because I cannot really quantify this unexpected. So I look at the price at which I buy the stock. If the stock is cheap, and the financials are good, the company has a lot of cash, in my opinion, the risk is very moderate or low to moderate, right? So there, I don't hesitate to put 5 to 10. I can go even up to 20% if really I have strong conviction on the product and on the growth, and it matches my macro, let's say, predictions of which sector will perform. If it happens to be in the right sector at the right time, I can even go 20% in it, but I usually like to have between 5 and 10% for exposure to every stock. And then, of course, there are some speculative bets. You need to add a bit of spice in your couscous to make it tasty. At least this is what we do in Morocco. So, for example, today I opened a very small position. I almost never open a position under 2 or 3% exposure, but today I opened a position that is of barely 0.35%, so 0.3, 0.4%. It's in a German battery maker called Varta. It produces batteries and it has deals with car makers, but it's swamped in a lot of troubles with its creditors. The previous CFO resigned, and today they announced a new CFO. So I decided to jump in, but only with 0.3% exposure because I think this new CFO could change things around. At least there is that potential. Worst case scenario, my downside is only 0.3%. Right? I cannot go under a value of $0. So that's my worst case scenario. The best case scenario, I do 10x, 100x, maybe even on the stock, right? It's not probable that I will do 10 or 100x. The probability is very low, but a 0.3% downside is nothing. It's nothing. So I decided to put 0.3% in that stock. So it's also in those terms you need to think in terms of financials and valuation on one side, and on the other side, what is your maximum downside in a position, right? So this is how stocks work, but crypto is completely different. And I think Timothy's very well positioned here to discuss how to pick cryptos, because I know a lot of our listeners, they also buy cryptos. Timothy, if you want to go ahead, maybe to cover the crypto part. How do you manage risk in crypto?
Or just how you manage risk in your investing all throughout,
Yeah.
Yeah, so for me, stocks crypto is totally different. Like Akim saying, stocks, I look at the valuation, I calculate the valuation, I see if it's undervalued. But I know in advance how much I want to allocate. So let's say I want to allocate 5% to that stock. Let's say Nvidia. I heard it's a good stock. And
yeah,
then
me too.
It drops to one level of support. So I look at the price chart. It drops to one level of support, and that's when I buy. But I draw 5 levels on the chart, like 5 levels I want to buy a stock. And so whenever Nvidia drops more, I will buy a second layer, 2% of Nvidia, 3% if it drops even more, until I have my 5%. And at the end of the road, I don't have cash anymore to invest in Nvidia. If it drops more, I will just manage my risk. I won't go higher. I won't invest more than I have, and I will just let it ride and just wait for it to recover. So that's for stocks, no stop loss. For crypto, I look at a chart and I look at how the trend is going. You want to buy altcoins that are in uptrends, because if you're buying an altcoin in a downtrend, you never know when it's gonna stop dropping. So you have to put the odds in your favor. Like Nestor, you said, you have to weigh the probabilities. Is it gonna have strength, continue higher? then you can, once it's bouncing off a certain level, for me, I'm always watching the 200 moving average. You can add the indicator on TradingView easily. But each time it drops to the 200 moving average, I know here is the place where buyers have to step in. And that's also when I put 2-3% of my portfolio in one altcoin. And then if it can bounce, I will just ride it further. If it drops, I make sure I manage the risk. I put a stop loss, and I have like a mental stop loss where I don't want to keep holding that bag. And that's usually below the 200 moving average for me personally. So that's the difference.
Okay, I wanna throw a question in the pit for a second.
I also had a question actually, because
Okay, go with your question and I'll ask it.
We do talk a lot about buying, right? But portfolio management, portfolio allocation, risk management is not only about buying, right? It's also about selling, knowing when to exit. And this is something we didn't really touch on it yet, right? So I don't know if Nestor, you wanted to ask something else.
Okay. Let me ask this question because it's directly related to this. But then I have another question for the conversation we're about to have. So the question is simple. Akim and Timothy, stop loss, yes or no? Don't explain to me why, whether you put it or not.
No stop loss, no take profit, no automatic one. No. I don't like when I don't like when an app makes a decision for me. I don't care if a price is hit by the chart, and no, I want to be the one making the decision after reading and seeing what are the news, did the fundamentals change. So no stop loss, no take profit at all, never.
Timothy.
For stocks, no. For crypto, yes.
Okay, you see, important because crypto's 24 hours. You don't get the gap up. You don't get the gap up
sleeping.
because yeah. Is the truth?
Yeah.
No, for me, I don't put them.
Even crypto, never, because you could have some stupid news. I don't know. Like imagine the White House Instagram account from the White House, from the US White House, get hacked and says the Russians are nuking us. Right? It could be true, right? So you can imagine the panic, and this could happen during the night.
But there could be strategies. There could be strategies to do that. You set up your stop loss, but then at 10% lower, you set up your buy order. So it's interesting. I think there's a use case. But I don't use them myself. I'm against them. I'm against them because, like you, I want to be able to know why the market is freaking out. For example, in the DeepSeek saga, the next week was me figuring out everything I didn't know about the Chinese and AI. All of it. And then you start realizing, no, the Chinese, they have the GPUs. They just bring them from Singapore. Yeah. There's still cocaine. There's still cocaine in the States, and it's illegal. You know what I mean? Like, they have their tips. But yes, cool. Okay, so now let's talk. So take profits, Akim. What is your view on take profits? Because for me, it's usually I have targets, but those targets grow as the company continues to produce well. So for example, my target right now to sell NVIDIA is 160. But that's what I think potentially the high range of the value of the stock is. Potentially 150 is fairly priced because we have grown. Every quarter the company produces
Nestor,
more, it increases.
I'm sorry, but it makes no sense what you just said.
What do you mean?
You said the value is at 150 or 160. Is that today, or is that what if the stock hits 150, 160 3 months from now? 3 months from now is 3 months of growth.
Exactly. So then, but then my price target will go up.
So your price has to move again.
Of course. I think that 160 is fairly valued for NVIDIA.
So what's the point having a price target then if it moves all the time?
Because you're not buying. I'm not buying a house that does nothing. I'm buying an asset that continues to increase. But the thing is like, so let's say this is the line for the price. What I think the price should be doing as time goes by. If the stock goes higher than that price, it's overvalued.
Yeah. What do you do then?
Overvalued. Then you start repositioning. You can get out of 5%, 10%, 20% of your position, and then buy when it's, because you're gonna get that volatility. The more it moves, the more percentage profit you can get out of an asset, the more volatility is likely to have. Bitcoin is one of those examples. Nvidia is one of those examples. We're seeing massive moves in Nvidia because the price discovery of the stock, people still don't know what they're buying. So the price is something that is moving as time goes by. It's like from this quarter to this quarter, if they meet my expectations in their revenue and their earnings, the value of the stock should be this. And that's how I think hedge funds figure it out. You know what I mean? Because like Amazon is not the same company that it was 10 years ago. But if they offer me the price of 10 years ago of the stock today, I would have sold it. Same with Nvidia. If you give me Nvidia at 2000 or, okay, 200 because of the split, Nvidia is not growing that fast, right? The future growth that I see in the stock is not that. So that's where potentially I think is like there are chances where you can actually get in and get out. But again, this is with my short term part of my portfolio, which is like around 20%. Because I don't want to miss a potential rally like crazy because the market can be irrational longer than I can be
greedy.
Right.
Then you
For
can be
sure.
greedy even, huh? Longer than you can be greedy.
Of course,
Is so my way of saying is it's a little different, a little bit different. Huh? So, but everyone has his own way of seeing. For me, when I don't really care if a stock I currently own becomes overvalued based on the valuation today. What I try to see is based on the valuation in the next 12 months, whether it is overvalued today. So I try to always look, 12 months from now, whether the stock price will be higher than it is now or not. So a stock can be overvalued today at the stock price today based on its earnings today. But when a company has really high growth potential, maybe that overvaluation today, for example, TSM by all metrics is overvalued today, but it does have a potential to be at least 20% higher a year from now because the earnings could justify the strong valuation, right? So that's why I was telling you for the price targets, maybe, I don't know, I don't like to have price targets. I just like to see every quarter I do a review of my portfolio at the end of every quarter, and I see whether there is still at least 25% upside on a conservative basis. This means that if the company grows at a normal growth rate in relation to the growth rate it had in the last 5-10 years, if there is at least 20% upside in a base case, in a very conservative base case, if the answer is yes, I keep it. I don't sell. I don't even sell a bit. I keep it. If the answer is no, I may completely exit or at least exit a good portion if I see the momentum at least is still there and there could be some upside surprises. And then this money I reallocate in other stocks that in my opinion have more upside depending on valuation and depending on number of different factors. So that's for stocks. But then for cryptos, there I do have a price target. My price target currently, at least because we are supposed to be in a bull cycle this year. Last few weeks, a lot of people capitulated and gave up, but I think, this is part of the bull cycle. For a lot of cryptos, my targets are not their previous all-time highs from 4 years ago, but kind of close to them for a lot of the cryptos that I have. But for crypto, I think you have to use charts mostly. Charts, and you try to see with the market cap, whether it's kind of in line with similar projects. But yeah, for crypto, I think you cannot use a lot more than charts to decide when to exit. But for cryptos, in any case, for me, is short term. So at the end of this year, I'm completely out of crypto. I want to have it just for this year because it's where we are in the crypto cycle. And if the same happens as 4 years ago and 8 years ago, we're supposed to have a nice altcoin season this year. I do think we need the Fed to give a green light for the altcoin season to happen. Maybe inflation to tick a bit down, but that's a topic for another day. What about you, Timothy? Do you see it the same way? For crypto, do you have also a different way for stocks?
For both, yeah. So for stocks, it's quite easy. Let's say looking at Meta, it had 20 days green in a row. Then 20 days in a row, it was pushing green candles, but it's still decently overvalued. Not like 50% overvalued, but based on my calculation, 10%. So 10% for me is still okay. If, for example, let's say Palantir rising from below $10 to now 120, I mean, my valuation for Palantir is around 40, and now it's triple the amount. So yes, I'm gonna take profits on that stock.
By the way, Meta stock is down 2% today. I'm sure Nestor was checking that. It's down 2% today.
No,
Meta.
I need to sell my SMCI calls. I need to make. I need to. I need to sell my SMCI calls. It's
So
at 60 now. It's too much.
Looks like it's the end of the running streak. Yeah. What about crypto? Sorry.
Yes, crypto. I look at the chart, of course. Crypto is more like trades, and I think that if you're a trader, you have to pay yourself. So whenever an altcoin or a crypto, it goes up, it doubles in a few weeks, few months, at least take off 25%. And that's the reward you get for that good idea you had to enter that trade. And then you still have some ammo left to let it run.
And do you do any gradual selling, like you do gradual buying? You mentioned that when a stock drops, from certain thresholds, you buy a bit more and a bit more, 2% more. Do you also do gradual selling, or you like to exit at once a specific position?
No, so Palantir, I sold 1% when it was at 80. Then I sold another percent when it was at $100. And then I sold another 1% when it was at 120, for example. So I'm also gradually selling the stock, but I also want to leave a bit of ammo in case it keeps running, because we're now in the AI boom, and I think Palantir is an important player within the space. So it's like your lottery ticket in case it keeps running. So I don't want to be completely out.
Yes, it makes sense because, something that people need to be aware is a small handful of winners make the most of your returns in the long term. Sometimes one single stock can make really the most of its returns when it's, a 10 bagger or even a 100 bagger. So it's really important to be careful with your winners, not to try to sell them and then to invest in your losers. So you have to be, it's part of, I think it's the hardest part actually of portfolio allocation.
The thing is, people always want like a 10 bagger, and whenever their stock doubles, they're already completely out. And then how can you ever have a 10 bagger if you sell after 2x? So you have to have the stomach to hold also to the upside.
Absolutely. And you need to also have the patience because the 10 bagger, usually you don't do it in a few months. It can take a decade even to have that 10 bagger.
GameStop?
Nvidia.
No, Palantir was in 3 years.
Okay, so let's head to the last little bit. Let's try to keep this one quick, but it's gonna be an interesting one for sure.
Nestor, I'm noticing you avoided the question about when to exit.